Life is full of surprises, and unfortunately, not all of them are good. One minute everything is going smoothly, and the next, you're faced with a challenge you didn't see coming. This is where financial preparedness becomes crucial. Imagine your car suddenly breaks down. The engine sputters and you're left with a hefty repair bill. It's an expense that wasn't in your monthly budget, and now you have to figure out how to cover it. Or perhaps a sudden medical issue arises. An unexpected trip to the doctor or dentist can result in bills that quickly add up, creating immediate financial pressure. These situations are common and can happen to anyone at any time. Even something like a broken appliance at home, such as a refrigerator or a washing machine, can disrupt your life and your finances. Replacing these essential items is costly and often can't be delayed, forcing a quick, stressful decision. Without a plan, these events can cause immense stress. You might find yourself worrying constantly, losing sleep over how you'll pay for everything. This financial anxiety can take a serious toll on your overall well-being and mental health. Many people turn to high-interest credit cards to cover these costs. While it solves the immediate problem, it can create a long-term cycle of debt that becomes increasingly difficult to escape, making your financial situation even more precarious. This is a scenario faced by millions. The feeling of being unprepared and one emergency away from a financial crisis is a heavy burden to carry, but there is a powerful tool that can change this entire picture completely. That tool is an emergency fund. It's your personal financial safety net designed to catch you when you fall. It transforms a potential crisis into a manageable inconvenience, giving you peace of mind and control over your life. So, what exactly is an emergency fund? In simple terms, it's a stash of money set aside specifically for unexpected expenses. Think of it as your own personal insurance policy against life's financial curveballs and sudden turns. The key purpose of this fund is to cover essential costs when you have a sudden loss of income or a major, unforeseen expense. It's there to handle true emergencies, not for everyday spending or planned purchases you might have. It's crucial to understand what this fund is not for. It's not for a vacation, a down payment on a new car, or the latest smartphone. Using it for non-emergencies defeats its purpose and leaves you vulnerable. This money should be liquid, meaning you can access it quickly and easily when you need it most. It shouldn't be tied up in long-term investments like stocks or real estate, which can be slow to sell. Think of it as a buffer between you and debt. When an emergency strikes, you can use your fund instead of reaching for a credit card or taking out a high-interest loan, saving you money and stress. It's also separate from your regular savings account. While your savings might be for planned goals like a house or retirement, your emergency fund has one job: to be there for the completely unexpected moments in your life. Having this separation is a psychological trick as well. By labeling the money for emergencies only, you're less tempted to dip into it for something that isn't a genuine crisis, keeping your safety net intact. Ultimately, an emergency fund is about freedom. It's the freedom from worry, the freedom from debt, and the freedom to make decisions based on what's best for you, not out of financial desperation. It's a cornerstone of stability. Let's visualize two different scenarios. In both, an unexpected event occurs, like a sudden job loss. The outcome, however, is dramatically different depending on whether an emergency fund exists. This is where its true power is revealed. On the left, we have someone without an emergency fund. When their income disappears, panic sets in immediately. The pressure to find any job right now is immense. There is no cushion to fall back on, only rising anxiety. Bills for rent, groceries, and utilities continue to arrive. Without income or savings, this person is forced to rely on credit cards or loans to stay afloat. Each swipe digs them deeper into a hole of high-interest debt. The stress affects their health and decision-making. They might accept a lower-paying job out of desperation, setting their career back. The financial instability creates a ripple effect, impacting all areas of their life negatively. Now, let's look at the right side. This person has an emergency fund. When they lose their job, it's still stressful, but there's no immediate panic. They know they have a buffer to cover their essential expenses. They can continue to pay their bills on time using their dedicated fund. They don't need to rack up credit card debt. This financial stability allows them to breathe and think clearly about their next steps and options. With their expenses covered for a few months, they have the time to search for the right job, not just any job. They can negotiate a better salary and find a position that aligns with their long-term career goals. The difference is clear. An emergency fund doesn't prevent bad things from happening, but it completely changes your ability to handle them. It provides stability and options when you need them most, turning a crisis into a challenge. The big question is, how much money do you actually need in your emergency fund? While the exact number is personal, a widely accepted guideline is to save 3 to 6 months' worth of essential living expenses. What are essential expenses? These are the costs you absolutely must cover to live. This includes your rent or mortgage, utilities like electricity and water, groceries, transportation, and any minimum debt payments you might have. It's important to focus only on the essentials. This calculation does not include discretionary spending like dining out, entertainment, subscriptions, or vacations. We're talking about your core survival budget, the bare necessities. To calculate your number, start by tracking your spending for a month. Add up all your essential costs. Let's say your essential expenses total $2,000 per month. This is your baseline figure for the next step. Now multiply that monthly total by 3. In our example, $2,000 times 3 is $6,000. This is your minimum emergency fund goal. It provides a 3-month cushion to handle a financial shock. For greater security, you can aim for the 6-month mark. That would be $12,000 in our example. This larger buffer is ideal if you have a variable income, a single-income household, or dependents. Don't let these large numbers discourage you. The goal isn't to save this all at once. The journey of 1,000 miles begins with a single step. The most important part is getting started, no matter how small. Having a clear target, whether it's the 3-month or 6-month goal, gives you something to work towards. It turns a vague idea of saving money into a concrete, achievable mission with a defined purpose. Now that you know the why and the how much, let's focus on the how-to. The first and most crucial step is simply to start. Don't be intimidated by your final goal. Just focus on saving your first dollar. A great initial target is to save a small, manageable amount, like $500 or $1,000. This is often called a starter emergency fund. It's a quick win that can build momentum and motivation for you. How do you find this initial money? Look at your budget and find small areas to cut back. Maybe it's brewing coffee at home instead of buying it, or canceling a subscription you don't use. Small changes add up. Another strategy is to direct any unexpected money, or windfalls, directly into your fund. This could be a tax refund, a bonus from work, or even cash from a birthday gift. Earmark it for your fund immediately. Consider selling items you no longer need. Decluttering your home can not only create a more organized space, but also generate some quick cash that can give your starter emergency fund a significant and immediate boost. The goal here is to create the habit of saving. Every time you contribute, you are reinforcing a positive financial behavior. It's less about the amount and more about the consistency of your actions over time. Once you hit your starter goal, celebrate that achievement. You've taken a massive step toward financial security. This initial fund is enough to cover many common small emergencies, like a flat tire or a minor repair. With this first milestone reached, you'll feel empowered to continue. You've proven to yourself that you can save, and now you can move on to the next step, making the process even easier and more consistent through automation. The secret to building your emergency fund from a starter amount to your full 3 to 6 month goal is automation. This means taking the decision-making out of saving and making it a seamless, effortless background process. The most effective way to do this is to pay yourself first. This principle means that as soon as you get paid, a portion of that money is automatically moved to your savings before you have a chance to spend it. Set up an automatic transfer from your checking account to your dedicated emergency savings account. Most banks allow you to do this online for free. You can schedule it to happen on the same day you receive your paycheck. How much should you transfer? Even a small amount, like $25 or $50 per paycheck, makes a huge difference over time. The key is consistency. Choose an amount that you won't be tempted to cancel. By automating the process, you remove willpower from the equation. You don't have to remember to save or feel the pinch of manually moving money. It just happens, quietly building your financial security in the background. Over time, you can gradually increase the amount you're automatically saving. If you get a raise or pay off a debt, you can redirect that extra money into your emergency fund, accelerating your progress toward your goal. Think of it like a dripping faucet slowly filling a bucket. Each small automatic transfer is a drop. It might not seem like much at first, but over months and years, those drops accumulate into a substantial reservoir. This set it and forget it method is the most powerful strategy for reaching long-term financial goals. It ensures you are consistently building your safety net without adding another task to your busy life. It's simple, effective, and powerful. You're saving consistently, but where should you keep this money? The location of your emergency fund is just as important as building it. It needs to be safe, separate from your daily spending, and easily accessible. Do not keep it in your primary checking account. It's too easy to accidentally spend the money if it's mixed in with your regular funds. The goal is out of sight, out of mind, until a true emergency arises. Keeping a large sum of cash at home is also not ideal. It's not secure, and it won't earn any interest. Your money should be working for you, even if it's just a little bit, while it waits. The best place for your emergency fund is a high-yield savings account. These are typically offered by online banks and pay a much higher interest rate than traditional brick-and-mortar bank savings accounts. It's the perfect balance. A high-yield savings account keeps your money safe and insured up to the federal limit. It also allows your fund to grow passively over time, helping to counteract the effects of inflation on your savings. Because they are often at a separate bank from your checking account, it creates a small but helpful barrier. You can still access the money in a day or two via transfer, but it prevents impulsive, non-emergency withdrawals. Opening one is easy and can usually be done entirely online in just a few minutes. This is where you will direct your automatic transfers, allowing your fund to build up in its own dedicated, optimized home. By choosing the right account, you ensure your money is secure, accessible when needed, and earning the best possible return for a safe investment. It's the final piece of the puzzle for a robust and effective emergency fund. Let's return to our original scenario. An unexpected expense appears, like a major car repair. But this time, you are prepared. You have followed the steps and built your financial safety net. The situation is completely different. Instead of panic, you feel a sense of calm. You know this is exactly what your emergency fund is for. You can assess the situation logically and make a clear decision without the pressure of impending financial doom. You simply transfer the necessary money from your high-yield savings account, pay the bill, and move on with your life. No credit card debt, no borrowing from family, no sleepless nights, just a problem solved. After using some of your fund, your next step is to simply pause other savings goals and focus on replenishing it. You just restart your automatic transfers until your safety net is fully repaired and ready for the future. Building an emergency fund is one of the most powerful things you can do for your financial health. It's more than just money in the bank. It's a tangible form of peace of mind for you and your family. It provides you with resilience, allowing you to weather financial storms without derailing your long-term goals. It's the foundation upon which all other financial success, like investing and wealth building, can be securely built. The journey might seem long, But remember the steps. Start small to build momentum. Automate your savings to ensure consistency, and keep your fund in a safe, high-yield account where it can grow and be ready. Start today. Open that account. Schedule that first transfer, even if it's small. Your future self will thank you for taking this crucial step toward achieving lasting financial security, control, and true freedom. You can do it.